Okay, so you want to own a shopping mall. Picture it. The sun pouring through a 3-story skylight, escalators gliding families past a fountain, the smell of cinnamon pretzels drifting out of the food court, teenagers meeting up by the same bench their parents met at 20 years earlier. You're not just collecting rent. You're the mayor of a small indoor city, and every register that rings is ringing for you. Here's the problem. Almost none of that is how this business actually works. The mall you're picturing hasn't been a reliable business model in over a decade, and the version that still makes money looks almost nothing like the postcard in your head. Let's talk about scale first, because the numbers sound enormous right up until they don't. There are roughly 700 to 800 enclosed malls still standing in America, down from over 500 at the industry's peak. The retail real estate they sit on represents hundreds of billions of dollars in asset value. Total annual sales flowing through American malls still land somewhere in the $150 to $200 billion range. Sounds like a business printing money. Now here's the undercut. The actual net operating margin on a struggling to mid-tier mall after debt service often sits between 1 and 4%. Not 15, not 10, 1 to 4. A grocery store makes better margins than most malls do, and grocery stores are famous for razor-thin margins. That's the first crack in the fantasy. But a mall isn't one business. It's 4 completely different businesses wearing the same architectural costume. Class A malls think luxury tenants, $800 plus in sales per square foot, waiting lists of retailers begging to get in. Those are basically cash-flowing trophy assets, and there are maybe 100 of them left in the entire country. Class B malls are the regional workhorses, decent anchor tenants, moderate foot traffic, thin but survivable margins if managed well. Class C and D malls are the ones you've seen in dead mall videos, vacant anchor boxes, a Spirit Halloween where Sears used to be, and a management company just trying to squeeze out enough rent to cover the mortgage before the whole thing gets sold for land value. And then there are outlet centers and open-air lifestyle centers, which are a different animal entirely, lower build-out costs, no shared HVAC nightmare, and honestly, better economics than half the enclosed malls built in the last 30 years. Now let's talk about what it costs just to open the doors, because this is where the stomach starts to drop. Land acquisition for a mall-sized parcel, depending on market, runs anywhere from $15 million to $80 million. Construction itself, from mid-size enclosed mall in the 800, 000 to 1,000 square foot range, runs $150 to $250 per square foot once you include structural steel, HVAC for a climate-controlled interior the size of several football fields, and a multi-level parking structure. That's $150 million to $250 million in construction costs alone before a single tenant signs a lease. Then add anchor tenant incentives, because here's the part nobody budgets for going in. You don't just lease space to an anchor department store. You often have to build their box for them, hand it over at a steep discount, sometimes practically give it away, because their name on the directory is what pulls the small shops in behind them. Total cost to open the doors on a serious regional mall, $200 million to $350 million, easily. This is not a business you start with a home equity loan. So where does the money actually come from? This is the part that surprises almost everyone, because your first assumption is wrong. You think the money comes from rent, big stores, paying big monthly checks. Rent is actually the weakest layer of the whole structure. Base rent from anchor tenants is often shockingly low, sometimes just a few dollars per square foot per year, because anchors are treated less like customers and more like foot traffic generators you're subsidizing to keep everyone else paying full price. The real revenue engine is layered underneath that, and it stacks in a specific order. Layer 1 is common area maintenance, or CAM. Every tenant reimburses you on top of base rent for their proportional share of keeping the lights on, the floors clean, the HVAC running, security patrolling. This is where a mall quietly claws back a huge chunk of its operating costs, dollar for dollar, from the same tenants who are already paying rent. Layer 2, and this is the one almost nobody outside commercial real estate has ever heard of. Percentage rent, also called overage rent. Small in-line tenants, the shoe stores, the phone case kiosks, the mall's actual profit centers, don't just pay flat rent. They pay a base rent plus a percentage of their gross sales above a certain threshold, typically 5 to 10% of everything they sell past that number. So if a store does $50 more in sales this month than expected, some of that $50 is yours, automatically, built into the lease. Layer 3 is specialty leasing, the kiosks in the middle of the walkway, the seasonal Halloween pop-up, the phone repair cart. These short-term leases carry disproportionately high rent per square foot because there's no long-term commitment risk, and they can add hundreds of thousands of dollars a year in pure margin with almost no build-out cost. Layer 4 is ancillary income, paid parking in dense urban malls, digital advertising screens, sponsored events, even cell tower leases on the roof. None of this shows up in the fantasy version of mall ownership. All of it shows up on the actual P&L. Here's the insider trick, and this is the part that separates people who understand malls from people who just think they do. It's called a co-tenancy clause, and it's baked into almost every major lease in the building. In-line tenants negotiate a clause that says, if occupancy drops below a certain threshold, or if a specific named anchor closes, they get the right to pay reduced rent, or, in the worst versions, walk away from the lease entirely, penalty-free. Landlords agree to these clauses when times are good because they seem theoretical. They are not theoretical. The moment one anchor goes dark, co-tenancy clauses trigger across dozens of other leases simultaneously. And suddenly, a mall that was 92% occupied and profitable is legally entitled to a fraction of its previous rent roll before a single additional store has actually left the building. It's a landmine built directly into the paperwork of a healthy mall, and it's the reason dying malls die so fast once they start dying. One domino doesn't just fall, it's wired to trip 40 others. Then there's the daily bleed, and this is where the fantasy fully dies. HVAC for 1 million square feet of enclosed common area in a building that runs from November mall walkers at 6 a.m. to 9 p.m., holiday shoppers, costs real money every single day whether or not anyone actually shows up to shop. Security staffing for a facility that size runs around the clock. Snow removal on an ocean of surface parking. Escalator and elevator maintenance contracts. Marketing fund contributions to keep the mall's name in front of a public that has increasingly stopped thinking about malls at all. And underneath all of it, debt service. Because almost no mall is owned free and clear. And the mortgage doesn't care whether foot traffic is up or down this quarter. Every day the mall is open, it's burning cash just to exist, and that's before a single sale is rung up. Which brings us to the structural risk, the one domino wired to everything else. Modern malls are built around 1 to 4 anchor tenants, department stores that pull in the foot traffic everyone else survives on. When even one of those anchors closes, and department stores have been closing at a brutal pace for 15 years, it doesn't just remove one tenant. It triggers those co-tenancy clauses across the building. It kills the foot traffic the small shops were relying on, and it creates a dark anchor, a massive vacant box that's expensive to release, expensive to demolish, and sitting right at the mall's main entrance advertising decline to every remaining customer who walks in. This is not a random risk. It's structural because the entire design of the mall, the layout, the leases, the parking, the psychology of the shopping trip was built around the assumption that those anchors would always be full. Let's make this real. Randall Park Mall opened in North Randall, Ohio in 1976, and at the time, it was one of the largest enclosed shopping malls in the world, over 2 million square feet, 5 department store anchors, a full-size ice rink, and for a while, genuinely one of the busiest retail destinations in the entire Midwest. Through the 80s and into the 90s, it was the kind of mall that defined a region's identity. Then, starting in the late 90s and accelerating through the 2000s, the anchors began to fall, one after another, And just like the mechanism we described, each closure triggered the next wave of vacancies through co-tenancy pressure and collapsing foot traffic. By 2009, Randall Park Mall closed entirely. It sat abandoned for years, a 2 million square foot ghost building that became one of the most photographed dead malls in the country, a symbol in documentaries and news segments about the decline of American retail. It was finally demolished between 2014 and 2015, and the punchline is almost too perfect. The site was redeveloped into an Amazon fulfillment center. The mall that once pulled shoppers away from Main Street was ultimately replaced by the exact thing that helped kill it. Here's the part that's genuinely a little dark. The most profitable moment in a dying mall's life is often not when it's full. It's the demolition and land redevelopment. The real estate underneath a dead mall, especially one near a highway interchange, is frequently worth more as raw land for logistics, housing, or mixed-use development than the mall itself was worth as a retail business in its final decade. Nobody puts that in the brochure. So how do the smart, well-capitalized players actually make this work? They don't play the same game you'd play as an individual owner. Companies like Simon Property Group, the largest mall operator in America and a publicly traded REIT, don't rely on any single property to perform. They own dozens of malls across every class. So the Class A trophy assets subsidize the weaker Class B and C properties in the portfolio. And they use scale to negotiate anchor deals, insurance, and financing at rates an individual owner could never touch. REIT structures also come with a specific tax advantage. Real estate depreciation can shelter a huge portion of operating income from taxes, even while the underlying asset is arguably appreciating in land value. And increasingly, the sophisticated operators aren't trying to save the traditional mall model at all. They're converting dead anchor boxes into apartments, medical offices, self-storage, or logistics space, essentially harvesting the land value and infrastructure of a failed retail concept and repurposing it for a business that actually has a future. The mall business at the top of the industry has quietly stopped being a retail business and started being a real estate optionality business. Let's run the actual math, because the swing here is bigger than most people expect. In a good year, a mid-tier regional mall with 90% plus occupancy, healthy percentage rent from strong inline sales, and no major anchor vacancies might net $8 to $12 million in operating income on a property valued at $150 million. A respectable, if unspectacular, 5 to 8% return before you even account for appreciation. In a bad year, one major anchor closes, co-tenancy clauses trigger, occupancy drops to 70%. That same mall can see operating income collapse to $1 to $2 million, or even go negative once debt service is factored in, while the property's appraised value simultaneously drops by 30 to 50% because lenders and buyers now price it as a distressed asset. You're not looking at a slow decline. You're looking at a cliff, and the mall business is full of buildings that went over it in 18 months or less. So is it worth it? Honestly, it depends entirely on which version of this business you're actually buying, and that's not a hedge. That's the whole point of everything we just walked through. If you're buying a Class A trophy mall with irreplaceable location and luxury anchors, or if you're buying at scale like a REIT with dozens of properties diversifying your risk, this can still be a genuinely strong, long-term real estate play. If you're an individual buying a single Class B or C regional mall, because the cap rate looks tempting on paper, you are betting your entire net worth on anchor tenants staying in business in an industry that has been shrinking for 2 decades. And that is not an investment. That's a hostage situation with extra steps. A shopping mall was never really the product. It was always just real estate, wearing a costume of permanence that the market eventually saw through. But that's not the whole story, because the industry didn't just sit there and die quietly. There's a whole layer of how this business actually adapted, and who's still quietly making money off it. That's worth understanding before you write the whole category off. There's one structural detail almost nobody outside the industry knows, and it changes everything about who's actually in control of a mall. In most deals, the mall operator doesn't even own the anchor boxes. Anchor tenants, the big department stores, frequently negotiate to own their own building outright, on their own parcel, carved right out of the middle of your property. You built the parking lot around them. You maintain the common areas they benefit from, but legally that box and the land under it belongs to them, not you. Which means when an anchor decides to close or sell that box to a discount retailer or a competitor or just let it sit vacant for tax purposes, there is functionally nothing you can do about it. You don't get a vote. You just get to watch the domino fall from the outside, on land you don't control, in the middle of a building you thought you owned. There's also a newer revenue layer that didn't exist 20 years ago, and it's becoming a genuinely serious part of how surviving malls stay alive. Data and media. Mall operators have realized that foot traffic itself is valuable information. Where people walk, how long they linger outside a storefront, what time of day draws the heaviest crowds, and that data gets packaged and sold to retailers the same way online ad platforms sell impressions. Digital directory screens, in mall advertising kiosks, sponsored wayfinding. All of it is essentially retail media. And for the malls smart enough to build it out, it's turned into a surprisingly high-margin line item, because unlike leasing space to a store, it doesn't require you to give up a single square foot. You're also seeing an entire category of tenant that simply didn't exist in the mall's original blueprint. Experiential and service tenants filling the boxes that used to be Sears and J.C. Penney. Trampoline parks, urgent care clinics, community college satellite campuses, gyms, even church congregations leasing old anchor space on Sundays. And look, some of this is a genuine adaptation, a real recognition that people don't need a mall to buy a t-shirt anymore, but they still need somewhere to go. Some of it, if we're being honest, is also just a marketing term dressing up a vacancy problem. Calling a struggling mall an experiential destination sounds a lot better in a press release than calling it what it actually is, which is a landlord who ran out of retailers willing to sign a lease. If you want to see this entire chapter of the mall story play out at the largest possible scale, look at American Dream in East Rutherford, New Jersey. This wasn't a traditional mall at all. It was conceived as a mega-complex combining retail with an indoor ski slope, a water park, and an amusement park, built on the idea that if shopping alone couldn't pull people in anymore, entertainment might. The project took over a decade longer than planned to open. Construction and financing costs stacked up into the billions, and it leaned heavily on public bond financing to get across the finish line. It's a real, extensively documented case of an operator betting that the future of large-scale retail real estate isn't retail at all. It's an entertainment venue that happens to have stores in it. Whether that bet pays off long-term is still being written, but the sheer scale of capital thrown at solving the nobody comes to malls just to shop anymore problem tells you how seriously the industry takes the threat. And here's a risk that has nothing to do with anchors or foot traffic at all, and it's hit the industry hard in just the last few years. Refinancing risk. Most malls are financed with commercial mortgages that come due and need to be refinanced every 5 to 10 years. And when interest rates rise sharply, the monthly cost of carrying that same debt can jump dramatically, even if the mall's actual operating performance hasn't changed at all. A mall that was comfortably profitable under a mortgage rate from a decade ago can become cash flow negative overnight simply because the refinancing math no longer works, regardless of how many people are walking through the doors. This is a risk that has nothing to do with retail trends and everything to do with capital markets, and it has pushed a number of otherwise stable malls into default in recent years for reasons that had nothing to do with their tenants at all. So the next time you walk past a mall that's still standing, still open, still half full on a Tuesday afternoon, that's not nostalgia keeping the lights on. That's a landlord who figured out the data, the leases, and the land underneath are worth more than the shopping ever was